Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. The Canada Pension Plan Investment Board ended its fiscal year with a net return of 7.8%. The increase in assets was boosted by income and transfers from Canada Pension Plan. The returns were helped by holdings in public equities and real assets. The results fell short of CPP's benchmark portfolio, which returned 13.2% for the same period. And we'll find out more on that when Amanda Lang speaks with John Graham, President and CEO of CPP Investments. You can watch that interview on Taking Stock. That's Friday at 3 p.m. Eastern. Shares of Lightspeed Commerce are taking a hit today. That's after the point of sale and software provider posted profit for its latest quarter that missed estimates. In addition, Lightspeed's revenue outlook for its current quarter, along with its fiscal 2027 goals, also missed the mark. And shares of Stellantis are under pressure in today's trading after the automaker unveiled a $70 billion turnaround plan. The major reset includes focusing roughly 70% of investments in key brands, including Ram, Jeep, and Fiat. The strategic outline also includes new savings goal and aims to boost profit and raise returns in North America and Europe by 2030. All right, we're keeping an eye on the TSX today as well. If we take a look, it is up by about 0.4% at the moment. It seems as though the energy and utilities sectors are boosting the TSX up today. We'll continue to watch that for you. U.S. markets down today, all trending down. The S&P 500, the Dow Jones down by 0.1%, and the NASDAQ down by 0.3%. Well, as geopolitical tensions continue, we are looking at where oil prices might ultimately settle once the conflict eases. You can see oil, WTI at least, up today by almost 2%. Joining us now to discuss that and more is Jerome Haas, partner at Lightwater Partners. It's great to have you join us. Thanks so much. Hi there. Can you hear me?
Yes, thanks for having us.
Great. Okay, so let's get started here. In terms of where you think oil will land once this conflict is over, whenever that may be, where do you think it will go?
Well, I think at the start of this year, a lot of people were focused on the midterm elections in November in the U.S. and thinking that Trump's going to do all he can to reduce the oil price ahead of that election. And so we were using about $60 for a low, an average of 65 for WTI for the year. Now, as a result of the events in the Middle East, we're looking at I think at least $15 higher than that. So our base case is now $80 WTI for the year and a low of potentially 75 in November. And so that's a lot higher, certainly than the start of the year. And so it's one of the reasons why oil prices are doing so well.
Because you say the longer the situation in the Middle East drags on, the higher the base case for the remainder of the year.
Absolutely, yeah. The Iranians are an oil investor's best friends these days. The longer they can drag out the negotiations and stop the bombs from falling in a ceasefire, the longer things carry out. And we could even see higher than $80 base prices. There is a real disconnect between the physical price for oil and the financial price, and eventually the two of them are going to merge, and we could see some real issues in the physical oil markets in the end of June and July as inventories get depleted.
When you say real issues, maybe can you elaborate a little bit on what you think we might see?
Well, I mean, the most obvious one is in the jet fuel prices, and they're talking about in Europe some chronic shortages there. We've already seen a lot of flight cancellations and reductions in the offerings and capacity. That could get much more pronounced, and it will have broader implications for the market, which is another reason why it's interesting that we're trading as high as we are on the overall stock market.
Yeah, I wanted to ask you about that. Market's trading at an all-time high despite what we're seeing in the Middle East. It sounds as though you're a little surprised by that.
Well, yeah, I mean, if you look at how the tech stocks in particular have done in the U.S. since the war started in Iran, they've gone parabolic. And the question is, how sustainable is that? Because it's really been pulling up the rest of the economy or the market in the States. And vicariously, it's been pulling up the Canadian market. But we don't share that enthusiasm if oil prices stay at $80 for the rest of the year.
With that in mind, though, you do have two investments that you believe people could take advantage of for the higher oil for longer scenario. So I want to go through those. The first one is Headwater Exploration. Tell us why it could maybe be an opportunity amidst all this volatility.
Yeah, well, both of these names are sort of under the radar mid-cap stocks in the oil space. They're particularly oil-oriented. In the case of Headwaters, I think the last quarter was 92% oil, so it's very heavy oil weighted. It's primarily a play in the Clearwater, which is one of the most prolific basins in North America and most productive. It produces about 25,000 barrels of oil per day, and we love the long-term nature of the Clearwater. It's essentially got relatively low declines, and yet you've got vast resources in place that could last for years. At the same time, you get about I think it's about a 3.5% dividend yield in the stock, and we just find these stocks to be very attractive given the long-term nature of the resources.
Cardinal Energy is the other one, so let's talk a little bit more about that and why you find this one attractive too.
Well, this one's very interesting. It's a conventional player, again, in Western Canada that last year added some SAGD assets, project in Saskatchewan. But if you look back a year in Cardinal, the stock was trading at, I looked it up, it was $6.17. It closed exactly a year ago. And so it was trading at a yield of about 11.6%. And so basically the market did not believe that they were going to deliver on their SAGD project because Canada being Canada, nobody delivers a project on time and on budget, especially for something that was new technology for Cardinal. And we flew out to Calgary last June to meet with management, and they were pretty convinced that they were going to deliver on time and on budget. And lo and behold, they did. And that's one of the reasons why they've had such a move in the share price. But they're still a very, very attractive play, and we think that it's still a reasonable valuation in the stock. On top of that, it's been so successful with their Renford SAGD project. They initially had a nameplate capacity of 6,000 barrels per day. In Q1, they came in at 6,700 barrels, so it was about 11% above nameplate capacity. And it's been so successful that they're going to launch another one. So this modular SAGD technology is relatively new to the market, and I just think it's a really interesting long-term story as well.
Interesting stuff. Okay, we will leave it there. Jerome Haas, partner at Lightwater Partners. Always appreciate your time. Thanks for joining us.
Thanks for having me, Lindsay.
Up next, is NVIDIA a buy after its blowout quarter? We'll have some more insight on that when we come back. Stay with us. NVIDIA surpassed first quarter Wall Street expectations on massive demand for its AI chips, but reaction from investors is rather muted. We found out why they are skeptical from Gil Luria, head of technology research at D.A. Davidson.
That's been the pattern the last few quarters. It doesn't matter how good NVIDIA results are. The stock, it doesn't necessarily react positively to earnings. A big reason for that is that we actually knew that NVIDIA would report this type of result a month ago when Microsoft, Amazon, Google, and Meta reported. Those companies drive more than half of NVIDIA's revenue, really. And so we knew that as those companies continue to spend on CapEx, continue to increase CapEx, NVIDIA would do well. The stock is up since then, which tells you that that was reflected in the stock. And today they just delivered the formality, or last night they delivered the formality. But mind you, very good results, beat, raise, staggeringly high numbers. They talked about selling 20 billion of standalone CPUs this year. That was zero last year. So their opportunity continues to grow. There was nothing bad about last night's result. It was all good. It's just that investors already knew that was coming.
Okay, so 90 billion, exceeding 90 billion for their revenue for the next quarter. Is that achievable? You just mentioned about that 20 billion. So is that achievable then?
Yeah, and in fact, over the last few months, the company's given us much more visibility than in the past. They've talked about $1 trillion cumulative business for Blackwell and Rubin, which means that they can continue to grow at these rates well into next year. And that's something that as investors get more comfortable with, they'll appreciate NVIDIA more. NVIDIA is already trading in the low 20s on forward earnings. It's unlikely that they'll trade at any less than that next year, and their earnings will be at least 50% higher. So that's why this is such a good setup for NVIDIA. They have more visibility than ever, and the stock is trading at the very low end of its historical multiple range.
All right, and you mentioned Vera Rubin. What makes it so unique, and is there anybody even threatening it right now to compete with it?
It's just much more performant in the sense that you can get a lot more tokens per dollar, which ultimately is what is important for AI, both mostly on the inference side, is what does it cost you to create a token, to drive AI, and their products continue to stay ahead of the competition. All AMD and Broadcom and the proprietary chips from the hyperscalers can do is try to keep up and at least for some applications have a slightly lower price point because NVIDIA is just much more performant with every generation of new semis that they introduce, new GPUs, and again, new CPUs as well. So they're staying ahead of the competition, and that's really the story of Vera Rubin, is that by the time the other chips catch up to Blackwell, NVIDIA shows up with Vera Rubin.
And with that, can AI replace these chips? Could somehow NVIDIA be replaced by AI?
Well,
I went on a tangent there for a second.
All of us.
I went on a tangent for a second.
Can replace all of us. Yeah.
Go.
Yeah, NVIDIA doesn't actually own its manufacturing plants. If you distill what NVIDIA does, they make a very complicated design file that they send to TSMC in Taiwan to manufacture. So could at some point AI be so good that it can design a better file and do that instead of NVIDIA or for NVIDIA? That's possible. But again, at that point, none of us have a job anyway, so we won't even have to talk about it.
Well, you and I are sitting on a beach then and talking about this, hopefully. Okay, other competition, China. Do they need to crack that market, or are they going to be good without it?
Well, it's a quarter of the global market, so they very much would like it to be part of their market long term. In the short term, they're just caught in this back and forth between the US government and the Chinese government about whether they can sell even degraded last generation chips. And at some point, the US government agrees and the Chinese don't, and then the Chinese don't agree and the US does. So it's been just back and forth for several months. Right now, none of us have Chinese sales in any of our NVIDIA expectations, but longer term, they do want to participate in the market. Again, it's a quarter of the global market.
And are the Chinese chips closer, getting closer?
They're getting closer, but it's the same thing. NVIDIA runs so fast that as the Chinese catch up to the last generation, NVIDIA comes up with the next generation. But they will address the domestic need in China because NVIDIA has been shut out of that market, and that helps them grow to scale and get better. And that's what NVIDIA doesn't want, is that it doesn't want this to be making Chinese semi companies better and bigger, and then using that leverage to sell outside of China. That's why NVIDIA wants to continue to sell even degraded chips into China in order to prevent the Chinese industry from developing to a point where they are competitors on a global scale.
All right, and NVIDIA, they're trying to diversify, and how important is that?
Yeah, so NVIDIA really controls the whole ecosystem. They're really the orchestrator of the great data center build out. They have had this foresight about how quickly it would come to be. So they've coordinated with TSMC in making the chips, with the memory companies, Hynix, Samsung, Micron, for delivering enough memory. And then they quietly decided that they're going to sell CPUs on a standalone basis because they anticipated that using AI in an agentic manner would require a lot more CPUs. They have networking equipment. They're working with the optical companies. They're the ones orchestrating the whole build out because they have all this foresight. And that allows them to participate in the most significant way and be in the middle of the build out, which means in the middle of the AI trade.
All right, and you still have it as a buy at $300 US.
That's right.
And no changes.
Not until they get over 300, and then we'll have to reassess.
That was Gil Luria, head of technology research at D.A. Davidson. Coming up, a multi-billion-dollar investment in quantum computing south of the border, what it means for the industry with our next guest after this. Stay with us. Quantum computing stocks are getting a boost today after the U.S. government agreed to award IBM $1 billion U.S. to build a foundry for quantum computing chips, along with smaller awards to other quantum computing companies, totaling a little over $2 billion U.S. The nascent technology is said to potentially deliver progress in fields like drug discovery, finance, and computing encryption. So joining us now to discuss that and more is Antoine Legault, Vice President in Equity Research at Wedbush Securities. It's great to have you join us. Thanks so much.
Thanks for having me. Appreciate it. So
this is a very interesting investment, $2 billion U.S. Is that enough? Like, what's your assessment in terms of how much is needed to scale effectively?
No, this today is a momentous day for the industry. I think today's announcement signals not just optimism, but commitment. Right, capital is being allocated, $2 billion, as you mentioned. Supply chains are being planned, and the ecosystem is beginning to coalesce around the idea that utility-scale quantum is a matter of when, not if. So historically, pure-play quantum companies have made the technical case, but now we're seeing, the incumbents like IBM, Global Foundries, making this industrial case, right? And that combination, frontier innovation meeting manufacturing scale, in our view, is how nascent technologies become transformative ones. So to answer your question, it's a big boost, but I would remind our viewers that most of the pure play quantum companies are very well capitalized already. So though it's not, a bit of extra cash doesn't hurt at the same time.
I wonder what the reason for it is then, right? Like the U.S. government is said to receive a stake in these investments. Is that part of the reason? Do you think that's worth the investment for the U.S. government?
Correct. I think the Department of Commerce now is institutionalizing, a new model of government participation, right, in a strategic technology development, and that it creates aligned incentives, tries to preserve taxpayer upside, and avoids the pure subsidy optics that have historically made policies politically vulnerable. But beyond the direct recipients and the $2 billion of funding being allocated across the industry, which is significant. We see the more important ramification as being the likely added positive attention this investment will bring to quantum companies, given the recent success the U.S. investments have had, like we've seen it with Intel, and the perception that U.S. policies going forward will be tailored to continue to support these investments. And then the last thing is just the national security halo effect it provides the entire space.
Got it. Okay, so I think just for our viewers that maybe don't know, maybe we can talk a little bit more about quantum computing, what it does, first of all, compared to other methods, and just maybe explain that before we get further into this conversation.
Yeah, absolutely. So at its core, the promise of quantum computing is that you could solve problems that are now intractable, or in other words, impossible to solve. Right. So it's not just about a speed up in compute time or marginal improvements. It's about a paradigm shift to one day being able to solve problems that otherwise are not possible to with today's supercomputers or even state-of-the-art high-performance computers. So what that means is solving protein folding or discovering new drugs, and same with batteries. Battery technology could use some help from quantum computers, solving very, very large problems that would take thousands of years for today's traditional computers to solve.
Then I wonder how it could potentially impact other technologies like AI, for example.
Yeah, absolutely. So in the future, the promise, or what pure play quantum companies have said, is that they plan on integrating AI data centers, right, which is now sort of a multi-$100 billion industry. We're seeing that across multiple companies that are deploying hundreds of billions of dollars a year in AI capex. So the long-term promise is that this industry will merge together with AI and improve large language models, improve efficiency, and there's just so much that we don't yet know in terms of what it can do, right? Because we're not yet at the point where we've reached quantum advantage, so to speak, or the fact that quantum computers could outperform classical computers. We're not quite there yet, so there's a lot that we still don't know, but it's a very promising field.
Out of the companies named to be receiving this investment, right, these funds coming from the incentives under the 2022 Chips and Sciences Act, which ones do you think, besides IBM, like there's a couple of others, Global Foundries, for example, D-Wave, which one do you find is building something of significance to kind of watch out for?
Well, it's difficult to pinpoint exactly which company, because they all have unique approaches and they all have promising technologies. So, of course, IBM has sort of established itself as a leader in the field, given the size and scale, and also they have the manufacturing and they have the history behind it. But Rigetti and D-Wave, I think notably, have very promising technologies and roadmaps. So I think those two would be some to watch for.
And just in terms of sectors, quantum computing referenced as effective for drug discovery, encryption, finance. Is there a certain industry or sector that could potentially strengthen the most once quantum computing really gets up and running?
Well, I think what has been said is the pharmaceutical industry could tend to benefit from quantum computers, given just the large amount of computation needed to do protein folding and drug discovery. I mean, that is an area that I think some of these companies are seeing a lot of interest from already.
Okay, we'll leave it there. Such an interesting conversation. Antoine Legault, Vice President in Equity Research at Wedbush Securities. Appreciate your time. Thank you.
Thanks for having me.
Up next, we look at property and casualty insurance and how the market is performing in Canada. Stay with us. That's next. Shares of Lightspeed Commerce are taking a hit. That's after the point of sale and software provider posted profit for its latest quarter that missed estimates. In addition, Lightspeed's revenue outlook for its current quarter, along with its fiscal 2027 goals, also missed the mark. And shares of IGM Financial are trading lower today. Mackenzie Investments, a unit of IGM, has cut a number of portfolio managers as part of a broader restructuring. According to a report from Bloomberg, the Canadian fund manager cut staff in its investment management, technology, and product divisions. This report follows a move by Mackenzie earlier this month, where it made a series of changes to its manager and product lineup. And shares of Walmart are in the red after the world's largest retailer missed its profit forecast for 2027. The retailer says benefits from favorable merchandise and business were offset by higher fuel costs. On the upside, same-store sales and revenue in the latest quarter saw growth, with global e-commerce sales rising significantly. And we're watching the TSX today. It is in the green, up almost a full percentage point at this point. We'll continue to watch that for you. Different story if we look south of the border, though, with U.S. markets. Well, they were trading down. Now they're trading a little bit up. This could continue as the U.S.-Iran standoff kind of boosts oil once again. We saw these markets trading lower. It seems as though they're on the uptick this afternoon, all up ever so slightly. The Dow Jones in particular up by 0.3% at the moment. Property and casualty insurance covers both protection of personal assets and protection from liability against third-party claims. Let's hear more now from Rowan Sanders, CEO of Waterloo-based Definity. It's great to have you join us. Thanks so much.
Thank you very much. Nice to be here.
So what is your view of the current P&C insurance market here in Canada?
It's in a good stage of development, I think, for us. As you know, Definity is been a building company, and we've just completed a large acquisition in the first quarter, which is early days, but going very well. And I would say the overall environment for the business is pretty attractive and pretty conducive to our long-term plans, which is to grow faster than the market and build a top 3 Canadian P&C insurer.
Let's talk about that acquisition of Travelers Canada. How has it contributed to the firm's recent performance so far?
Well, actually, our first quarter was a really important quarter for us because this is the first quarter that we published the earnings of the combined business. So on January the 2nd of this year, we closed the pre-announced Travelers transaction. So this is a very substantial acquisition, a $3.3 billion acquisition for Definity that moves us into the top 5 insurance companies. So very strategic. Closing went a little earlier, a little better than we thought. So that was all very good. And we've been very busy in the first quarter, now onboarding about 1,500 employees, about $1.5 billion of revenue, and starting to work on the integration plans for the business. So a really positive start to the integration process. And then I think the other thing that we were very pleased about was the core business delivered very strong performance. So our growth in the first quarter was 35%, heavily influenced by the addition of the Travelers portfolio. We had a combined ratio of 92.9%. And actually, we had a record earnings in the first quarter of an underwriting profit of $100 million. And that's the first time we've done that in the first quarter. And then in Canada, the first quarters for a P&C company can be a little tricky because we had a real winter, as well. So off to a very good start.
You say now you're in the top 5. I mean, as I hear you're onboarding more people because of this acquisition, but being in the top 5 now, has that changed how you're going to operate? Has that changed any of your models moving forward?
Well, I think one of the things it does is it actually adds a lot more capability and breadth of product offerings to the marketplace. So when I think about, Definity's journey, which we've been organically growing at about twice the rate of the industry, we've been increasing the share of our commercial business. So that's been the faster growing part of our business as we moved out of being just a small mid-market player into large and specialty. What was very strategic about the Travelers acquisition is that, we'll get somewhere around 35 to 40% additional growth in our commercial lines business. But what importantly it does is it opens up the total addressable market for our commercial capabilities by about $7 billion of opportunity. And so that's going to help us, continue the growth for some time to come. And it's given us, more relevance with our big broker partners and actually more products that we can then cross-sell into the existing Definity business. There are many lines of business that, for example, directors and officers, ocean marine, technology that Definity didn't offer to the marketplace. But now we've acquired Travelers. We have those products. We have the seasoned underwriting and claims capabilities to do it. It will be a new product offering for us.
Are you eyeing any other acquisitions at the moment?
Well, I think part of our story is that we're confident we've built a great platform that can help us continue to grow by both organic growth and acquisitions. And so we're always looking to deploy capital. I think one of the points that we're delighted about is we've just done this, I'd say, transformational acquisition. We spent $3.3 billion, as I mentioned. And here we are just 1 quarter in, and our financial capacity to do further acquisitions is already over $1 billion of capacity. And that's because the company is quite cash generative. The earnings are very strong, and we acquired a very strong balance sheet from the Travelers organization. So financially, we have the capacity to deploy more capital. And the real focus in the short term is about making sure that it's a smooth integration process. We retain the talent, we retain the customers, we make it a smooth process as we literally move on about 500,000 customers from the Travelers platforms onto the Definity platforms. But yes, we are still looking to deploy capital and continuing to participate in what we think is an industry that is going to continue consolidating.
Oh, interesting. Okay, so we'll keep an eye on that. I just wanted to ask you before we wrap things up here. Of course, in the last couple of days, we've seen a sharp bond sell-off, global yields rising on the Iran war for the most part. With that in mind, how are insurers considering investments in Canadian bonds at this time?
Yeah, it's a big part of our portfolio. So when you think about our investment portfolio, we have about $9 billion in our investment portfolio, heavily weighted to fixed income. I think that what we focus on is making sure that we have good duration matching between our liabilities and our assets. So that influences. We generally have about a 4-year duration plan. We have, however, traded up into higher yields in the last couple, of months. And actually, that's one of the positives that we've been able to up our guidance on net investment income for 2026. So we were targeting about $300 million of net investment income. We've now moved that up to over $320 million. So we've actually taken advantage of some of the yield increases available in the marketplace. It's a very safe, prudent investment portfolio. So we're watching, of course, what's happening around the global markets carefully.
For sure. Okay, we'll leave it there. Rowan Sanders, CEO of Definity. Appreciate you joining us once again. Thanks so much.
You're welcome.
Shares of Deere are down after the company posted a quarterly profit beat, but saw agricultural sales fall. We'll break down the full results right after this break. Stay with us. Shares of Deere are falling after the company posted second quarter results that topped expectations, but saw sales fall in its core agricultural business. Joining us now to break down the quarter is Jerem Nathan, research analyst in industrials at Daiwa. It's great to have you join us. Thanks so much.
Thank you for having me.
So Deere shares down today quite a bit with ongoing challenges, quote unquote, for farmers, is one of the stories coming out of the latest earnings report. How big of a headwind do you think that part is for the company?
Yeah, so in terms of the large ag market continues to struggle a bit here, especially, we actually saw some green shoots in terms of North America, but Brazil has weakened because of especially with input costs going higher and the interest rates higher in that region, as well as a stronger real. But from a North America perspective, I think we saw that combines, retail sales of combines were flattish year over year in 2Q, and pretty much, I think the focus is kind of shifted to 2027. As far as Deere is concerned, I think they have the orders kind of booked that goes through, their production's kind of locked through the end of this fiscal year. So the focus kind of is on 2027.
I wonder, is that why, because of the green shoots you mentioned for North America, is that why Deere kept profit outlook unchanged for the rest of this year?
Yeah, so that, so at the margin, I think the 2Q earnings were a bit disappointing. They had the IEPA credit refund, as well as a lower tax rate and higher outlook for construction, but they kept the outlook intact. That kind of results from a weaker Brazil, which kind of offsets all of those positives. In terms of pricing, they did lower their large ag pricing by 50 basis points. So that was kind of the offsetting factor.
The other big story coming out of this is, it seems to be, construction and forestry kind of offsetting weakness in agriculture. Can you talk about what you noticed there?
Yeah, so construction, and we have seen this with Caterpillar as well. So construction markets, especially in North America, is very strong. Data center is a big driver, as well as infrastructure, and there's some refleeting from the rentals as well. So they did raise their outlook from up 15 to up 20%. They raised their margin guidance as well. So that was part of the offset to the weaker agriculture, especially in South America. So with most of that kind of I would say, known, especially after what Caterpillar said and others have said. I think the market's kind of focusing on the incremental negative in terms of South America.
For sure. Construction and forestry sales, though, speaking of the negative, this is more of a positive. They jumped 29%. How much of that is, if any, is being driven by AI-related infrastructure build-out?
No, I think it is. It's to some large extent unlike CAT, Deere does not sell directly to AI infrastructure players, but in terms of construction, utilities, water, and just data center construction itself has been a big driver.
Some analysts pointed to the $272 million tariff refund as a major driver for the profit beat. How much credit should investors be giving that, though, as well as the underlying business itself?
So I would say, I think it's right. Most of the beat was driven by the $272 million. I would say about 75 cents per share. What was the impact there? But I think the construction market did do better than expected on the revenue side as well.
What about, obviously, we saw the U.S., Donald Trump had to Beijing recently to meet with Xi Jinping. Does the U.S.-China agreement on agricultural purchases help the outlook for North American farmers at all, which in turn would maybe help a company like Deere?
Yeah, no, absolutely. So if you kind of look at some of the positive factors like E15 and then the trade agreement, I think those should help. And we have seen grain prices go up over the last, they're probably up 15 to 20% if we compare soybeans, corn, as well as wheat. So that has to be kind of looked compared to the higher input costs. So in 27, I think it'll be an interplay between how much higher the grain prices go compared to how the input costs behave. Right. In terms of fertilizers and oil.
Yeah. Yes, exactly. I was going to say, you've got the higher grain prices, higher fertilizer prices, higher oil prices. You've got droughts in southern U.S. Like, that puts a lot of pressure on farmers when it comes to spending more, doesn't it?
As far as I think the farmers, if you look at farm income, I would think it should be better in 26 compared to 25 because grain prices, as I said, are higher, and they can sell the stored grains. I think the kind of what happens in 27 will depend on interplay between the prices and the input costs. Yeah.
And how are you thinking about Deere relative to some of its peers?
Yeah, I think relative to its peers, I think Deere has a significant advantage in terms of precision ag. Especially like as we talk about input costs, I think farmers could be, could kind of turn their focus to being more efficient. And in terms of that, like some precision ag solutions like see and spray, the farmers are seeing 60-70% reduction in herbicide usage using that solution. So I think there will be a shift. There could be a shift towards those kinds of solution, and take rates could go up even higher.
Okay, we'll leave it there. Jairam Nathan, a research analyst in industrials at Daiwa. I really appreciate your time. Thanks for joining us.
Thank you. Thanks for having me.
Still ahead, we've got today's Market Movers with Bloomberg's Matthew Griffin right after this. Joining us now for some movers south of the border is Bloomberg equities reporter Matthew Griffin. Matthew, it's great to see you. So going through a couple of different retail companies here. Walmart is the first one. Walmart's selling off as higher fuel costs pressure its margins. What was Walmart saying today?
Yes, well, Lindsay, Walmart, just the latest company to be punished by investors in this way as these impacts show up from the Iran war. And what Walmart said is that they are eating virtually the entirety of these higher fuel costs. So the company is paying more for fuel for some of its goods during the conflict, and it is not passing those costs on to consumers. That's been Walmart's strategy when there are price pressures. They like to keep their prices low. That helps them, hang on to their customers and even win customers who are being priced out at other stores. and that's been a winning strategy. This is often seen as a company that can weather geopolitical turmoil and pressure on U.S. consumers. Right now, though, we're seeing some of the downsides. The company said there was pressure on their margins during the war. You add to that sort of a mixed results and outlook from the retailer. The company's CFO said that high-income consumers are still spending, but low-income consumers are in financial distress. So that's an impact on results as well. And what you've got here is the stock down as much as 8% today. That's their worst day since late 2023.
It's so interesting when you talk about the high-income consumer versus the low-income consumer and the different spending trends, right? Like, as you say, the CFO for Walmart was saying that today. High-income consumers still spending. Walmart was a couple of months ago really starting to shift and cater more toward that high-income consumer. I'm wondering if we can see more of that in the future, given the trends we're seeing right now.
It is something that the company has spoken to, and in part that's because of these pressures here. So you think about the sort of K-shaped economy, the high-income consumers doing well, low-income consumers not. At the same time, what economists have been very interested in is, when does that start to crack? Are these high-income consumers sort of trading down to lower stores? And so that is something, who knows what we'll see going forward. But if we do continue to see it, if we see high-income consumers spending a lot at Walmart, that actually may not be a great sign for other American companies or for the American economy, because it might mean that high-income Americans are on the hunt for bargains, that they don't want to spend as much money and that they're facing some financial pressure. So this report, again, it seems like the signs of distress are for people who don't make as much money, but definitely something I think that investors and maybe even economists are going to have an eye on going forward.
For sure. And a perfect segue into the next company you want to talk about, and that is Ralph Lauren. Shares are up today quite a bit, up right now more than 14%. Luxury shoppers seem to be doing okay at Ralph Lauren.
Yeah, so this is a sign maybe that this K-shaped economy narrative is holding up, that there isn't so much pressure on high-income consumers as we've been talking about. This is the stock's best day in more than a year with that more than 14% gain. And what Ralph Lauren said is that sales for their luxury products are going strong. Consumers are willing to pay full price. They aren't seeking discounts. And that is not necessarily what investors were expecting. The bar was pretty low here coming into the report. Shares were down about 7% year to date. And it seems like the report really, they knocked it out of the park here. Revenue was nearly $2 billion in their most recent quarter. Analysts looking for about $1.85 billion, and adjusted earnings per share of $2.80, also better than expected. So again, this has been one of the stronger reports we've seen out of retailers, and one of the real bright spots in a week that has seen mixed reports from names like Walmart, from names like Home Depot and Target as well.
For sure. So interesting to see those two different companies and the parallels there. Okay, Bloomberg's Matthew Griffin reporting live for us. Matthew, thank you.
Thanks for having me.
Of course. Well, a face-to-face between the Prime Minister and the BC Premier yesterday, who has been critical of the agreement signed last week between the federal government and the Premier of Alberta, which could see pipeline construction start next year. CTV senior political correspondent Mike LeCouture has more in this report.
But the Prime Minister is a friend to British Columbia.
BC's Premier struck a friendly tone standing next to Prime Minister Mark Carney. It came a day after David Eby said Canada won't work if separatist premiers get all the attention, a reference to Alberta and Ottawa moving forward on the plan for a pipeline to the West Coast.
Developing our economy has to go hand in hand with environmental protection for the next generation, including the North Coast tanker ban.
Carney pointed out 1/3 of the projects identified as in the national interest are in BC. He also told the Vancouver Board of Trade he's looking for partners, not pushback.
We don't want to hear what people are against. We want to hear what they're for. And if you're for something, we will get behind you.
Carney's challenge is to sell that message while balancing the competing interests of each province.
I think what he's doing is he's saying, look, we are going to establish rules that will propel forward major projects create jobs and generate benefits for each province, for each part of the country.
Part of that balance includes working with provinces like Saskatchewan to apply the industrial carbon tax, which Premier Scott Moe is seemingly open to discussing.
To see if we can come to some type of an agreement that works for industry and doesn't impact negatively the industries that are creating jobs and making investments just like this in this province.
Carney and Eby have agreed to start negotiations on BC's economic priorities. However, the Prime Minister also told that Vancouver business crowd if things get stalled there, his government will spend time in the rest of the country because they need to move forward.
That was CTV's Mike LeCouture. And that wraps up this edition of Trading Day. Thanks so much for watching.